Hello and welcome to this video on accounting for business activities, where we will focus on how financial reporting reflects the underlying business activities of a firm and on developing an understanding of how funds are raised in the capital markets. In this first video, we'll be focused primarily on these first three learning objectives: understanding the role of finance in business, describing how financial reporting reflects underlying business activities, and understanding how funds are raised through the capital markets. In finance, we use the accounting measures reflected on financial statements to inform business decisions and to model the impacts of these decisions on a firm's future financial performance. So, accounting differs from finance because in accounting, we're focused on accounting for past activities of the firm, whereas finance is very forward looking and focuses on the future and decision making. Financial accounting is guided by principles that provide accountants with a framework for reporting a firm's activities, and these guidelines inform how an accountant might report a firm's business activities, but two different accountants may report the same activities differently and still be in compliance with our generally accepted accounting principles, or what we refer to as GAAP. One thing to keep in mind as we go throughout this course is that accounting requires a significant amount of judgment and is therefore vulnerable to variations in judgment by different accountants as they're interpreting the guidelines provided by GAAP. After running several businesses, I went back to school to actually earn a business degree, and the first course that I took was an accounting course. Walking into that class, I thought accounting was a pure and absolute science. I thought it was like basic math, 2 plus 2 is 4, and that is the answer. However, it was incredibly eye-opening to me to learn that there's not a single absolute way to account for a business's underlying activities. And accountants will book things at different values, and there's a lot of discretion and choice in that matter. So as we said, several different accountants may arrive at different measures of accounting profit, and all of them could still be in compliance with GAAP. So whereas accounting is focused on how financial statements are made, in finance, we want to focus on how to interpret and actually use those financial statements. So if you didn't love accounting, don't worry, we're not going to do T-charts and debits and credits. We're going to be focused on interpreting and analyzing these financial statements. But to do that, we do have to review some of our basic accrual-based accounting principles. Financial statements are a way of keeping score so that managers know how they're doing. And this applies to managers in all different departments. So any area that you end up working in, whether it's marketing, human resources, if you're in operations or production, if you can speak to how your department's contributions are contributing to the bottom line, that's going to go a long way in those senior positions. You're going to need to be able to interpret financial statements and do forecasts and projections. Financial statements convey a lot of useful information that can help us assess a company's strengths and weaknesses. It also assists in modeling the future impacts of various proposals, which we can do through forecasting. And we want to have a really solid understanding of financial statements, both, the managers of a firm, but also any outside users. So that might be a creditor who's considering loaning money to the firm, or an equity investor that might be purchasing an ownership share. How we interpret financial statements is largely dependent on our purpose for analyzing them. So if we were an internal manager trying to decide whether we should invest in a new warehouse or whether we should purchase another airplane to deliver our products, that's a very different use of the financial statements than perhaps a lender who's considering giving the company a loan. They're going to want to pay attention to different parts of the financial statement and would interpret them differently. A company engages in planning activities to determine what their goals and objectives are. Usually, a business plan will describe a company's purpose, its strategy, and the tactics that it uses to meet those objectives. So, a business plan would assist managers in focusing their efforts and identifying expected opportunities and obstacles. And then a company requires financing to carry out its business plan. A firm requires financing to carry out its business plan. Financing activities are the means that companies use to pay for their ventures. So the two different sources of business financing are equity investors, sometimes referred to as owners or shareholders, and creditors that lend money to the company. The operating activities represent the carrying out of the business plan. So these activities usually involve at least 5 basic components: research, purchasing, production, marketing, and labor. Operating activities are a company's primary source of income. That's the day-to-day operations of the firm. And then investing activities is the choice of what assets a company is going to need to actually operate the company. So you can think of financing and investing as two sides of the same coin. In financing, we're figuring out how are we going to pay for this? With investing, we're figuring out what are we going to purchase? Which assets do we need to run the firm? So the role of finance in business helps us address several key questions. One of them is the capital structure decision. So this is a fancy way of saying, how are we going to pay for this? This is that financing decision. How much equity should we use versus debt? How much of our own money versus borrowing money should we use? That's that capital structure decision. And then we want to think about our long-term investments. Which ones should we purchase? That's our capital budgeting decision. And finally, finance helps us address the question, how should we manage our cash flows from day-to-day operations? And that's what we refer to as our working capital decision. So to recap, financial statements help inform our business decisions. They reflect the underlying activities of the firm, and knowledge of financial tools is relevant for decision making in all areas of business and also in managing our personal finances. So there's a lot from financial statement analysis that you'll be able to apply to analyzing and making decisions in your own personal finances. Decisions tend to involve an element of time and uncertainty. And there's financial tools that help us adjust for time and risk so we can make better decisions. And also these decisions, they should be financially viable. So financial tools help us determine which options are the best routes and the financial viability of those decisions.